First keynote speaker is Mitch Hooke, who is Chief Executive Officer of Minerals Council of Australia. And he will give a speech titled on re-establishing Australia as a global supplier of minerals. And let me tell something about Mitchell. Mitchell Hooke has been Chief Executive Officer of the Minerals Council of Australia since June 2002. And he chaired the first APEC Mining Industry Forum held in conjunction with the ministers responsible for mining meeting in Perth 2007. Before joining the MCA, Mr. Hooke served as an inaugural Chief Executive Officer of the Australian Food and Grocery Council from 1995 to 2002. Prior to that, he was Executive Director of the Grains Council of Australia, and Mr. Hooke began his career as an agricultural advisor on Queensland's Darling Downs, where he pioneered zero-tillage ecological farming systems. Mr. Hooke is currently a member of the full council of the International Council of Mining and Metals and its executive working group based in London. Mr. Hooke is currently a director of Elgin National Industries. He is a director of the Australian operations, Roberts and Schaffer Australia. Mr. Hooke is deputy chairman of the Winfred West Schools Foundation Board of Governors, and Mr. Hooke is married with 3 daughters and lives in Canberra. Thank you.
May I firstly acknowledge the traditional owners of this land in which we meet, the Gadigal people of the Eora Nation, and extend the respects of the Minerals Council of Australia and my own to their elders and their ancestors. Conference Chairman Dr. Sirkin Sadam and members of the Conference Organising Committee, President of the AusIMM Peter McCarthy, Professor Bruce Hebblethwaite, members of AusIMM, distinguished guests. Absolutely delighted to be here, and thank you for the invitation. Before I get into my address proper, I thought it not a bad idea. I'm pressing left, aren't I? Yep. Not a bad idea to, for those of you not familiar with the Minerals Council of Australia, to give you a brief snapshot to provide you with some perspective for the context about which I'm about to talk about. We're the peak industry organisation representing the exploration, mining and processing industry here in Australia and internationally. We're a member company, private company, limited by guarantee, funded by our membership. We cover pretty well all minerals and metals, net of oil and gas. Our core business is pre-competitive public policy, leading principles and practices. We engage opinion leaders. We represent the industry. We're not a service organisation. I hate the word lobby, but we're a policy and strategic advocacy and, again, as I said, about the principles and the practices, and doing this sort of stuff, which is representing the industry at key national and international fora. When you asked me some 6 to 8 months ago to give you this keynote address, I suspect few, if any of you, would have contemplated the current turmoil and volatility in global capital and product markets and the global economy, notwithstanding that the signs were well and truly there. Indeed, many commentators late last year, 2007, were warning that fundamental issues affecting liquidity in global credit markets were being ignored, and some much earlier than that. At the Australian-Japan Business Council conference in Nagoya in Japan in September 2005, I shared a platform with Mr. Tsuyu Gieton, who was president of the International Institute of Monetary Affairs. And he then identified 4 key risks to the global economy. This is 2005 September. The structural imbalance within the US economy, the twin deficits of trade and budget and the ballooning current account deficit, and the inflated asset market bubble, which he considered then was on the verge of collapse. The extraordinary expansion of the global financial market, its fluidity and lack of governance, the geopolitical risks in the Middle East, and he named Iran and Iraq in particular, North Korea and international terrorism, and the price of oil. While these warnings figured and factored into our thinking, we were quite justifiably confident in the underlying fundamentals to the super cycle of demand for minerals products, and we were looking to the future at how best we could position Australia minerals industry to better capitalise on the strongest global market growth in a generation. We launched the 2020 Vision Project late last year with the objective of addressing the capacity constraints to growth inflicting or afflicting the industry today, and likely to continue to erode our market share and visit opportunity costs on this industry and the nation well into the future unless we did something about it. Our motive was to avoid repeating the mistakes of the past inactivity in building social and physical infrastructure needed to meet the burgeoning global demand of the industrialising and urbanising emerging economies. Indeed, we considered that capacity constraints were the economic policy issues of the moment and threatened to limit the scale and longevity of the current expansion. And I hasten to add that this included consideration, but not to this extent, of the medium to longer term outlook for global growth and the factors identified by Mr. Gyelton and others. This was what you wanted me to address today, and I will. But clearly I could hardly stand here before you and not put that through the prism of the current global economic developments. So to do this, I'm going to give you my take out of the current economic turmoil, the cause and the effects, and consider to what extent the underlying economic fundamentals to the structural adjustment in the global economy and in our industry have been compromised, and what that means to the focus and activities of the work of the Minerals Council of Australia, particularly under the 2020 Vision Project, which is what you asked me to talk about. Saturday night, late, this was my thinking behind how I structured this presentation. And anybody probably gives you more of an insight into how my mind works, but it is actually intended to give you a snapshot take-home message about how complex and integrated this all is. And to my disclaimer, this is my take-out. I write my own speeches, I do my own stuff, so I can get at least some handle of what I'm talking about. So this is my take-out, not the Minerals Council's, on account of the many and varied sources of information, and is intended to provide you with an appreciation, not the appreciation, and is provided with all care and no responsibility of how you might react or act in response to it. The current turmoil and volatility in the global capital and product markets and the economy is as a consequence of what I characterise as the perfect economic storm. It's a confluence of adversely reinforcing interrelated events, and I've identified four. It's going to be a bit techo to start off with, but we'll see how we go. First is the global economic growth was already, the first factor was that global economic growth was already slowing before the financial crisis. A slowdown of global industrial production and commodity demand, principally in developed economies, but also in the emerging economies, and notably in China. Just as China's growth was planned on the upside, so too its slowing, and now its rebalancing of growth. China is deliberately managing its way through long-term political and structural reform in a carefully planned and calculated manner. Its deliberate policies of slowing the economy before this crisis contributed to a rising cost base, particularly on the eastern seaboard, a revaluation of the exchange rate to stem capital inflows and reduce foreign-held reserves, and to increase consumer purchasing power, to rebalance to consumption more than a production-driven economy. And China removed a dozen subsidies that promote exports and discourage imports of steel, wood products, information technology and other manufactured goods. The impact had been profound. Tens of thousands of factories across the manufacturing belt for which Made in China has become symbolic. Clothing, footwear, textiles, toys and watches, electronics and white goods have had the worst year, 2008, they have experienced for some time. The property market had deteriorated in the main cities. The share market had lost half its value since the start of the year. Retail sales were depressed. Car sales had fallen for the first time in 2 years, and the construction sector was barely marking time. Given the primary economic drivers of China's economy are domestic demand, investment and consumption, these developments are significant. Unlike net export growth, which although it has stagnated, is not as significant, given that China is not an export-driven economy. Net exports only account for 16% of GDP when China was going gangbusters in 2007. As economist David Hale, and I've got a lot of time for this guy, has noted, 40% of China's GDP is export. 20% of that goes to America. That looks very high risk, but only 20% of the value of Chinese exports accrues to Chinese companies. 80% goes to countries elsewhere in Asia that supply China with intermediate goods and components to produce finished goods for sale to America and Europe. This is known as the Asia factory. So the reality is that only around 2% of China's GDP depends upon exports to the USA. In response to the downturn, China has already commenced a program of rebalancing growth through government moves to raise infrastructure spending. This is before they announced the $855 billion package. To lower interest rates, to increase export rebates and ease restrictions on property ownership. They're lowering interest rates on mortgages, transaction fees and taxes, and reduce down payments. Measures designed to boost construction, manufacturing and consumer spending. I hope you're getting the take-home message is that China plans what it does. Although China is considered the most important economy to global economic growth, the US is still the largest economy and a major engine of growth, even though the correlation of US and global growth has halved over the past decade. As I indicated earlier, the US has endured trade and budget twin deficits for some time, gradually and significantly undermining its growth. Indeed, the USA is headed for a structural recession for some time, whereas the rest of the world has started on a cyclical downturn. The US current account deficit is structural, driven on the one hand by domestic consumption without the backing of a strong industrial base in the US to produce the consumer goods it needs, and on the other hand, Asian savings, where Asian central banks deliberately accumulated foreign exchange reserves to offset their currency risks in the aftermath of the Asian crisis. I'll explain that a bit more later on. The US current account, therefore, is intermediating between Asian savings on one hand and US financial markets and hence the US consumer on the other. The savings of the rest of the world were essentially supporting a US current account deficit which reached nearly 7% of GDP in the first quarter of 2006. Which brings me to my second factor of this perfect storm, and that's the impact of monetary policy responses of the Asian economies to the late 1990s Asian financial crisis. As I said, Asian economies determined to accumulate foreign exchange reserves in US dollars to offset currency risks, to artificially peg their exchange rates, increase international trade competitiveness, and build current account surpluses, which in turn fed back into their foreign reserves, and with particular aim of avoiding having to call on the IMF in subsequent crises. Asian central banks were buying US bonds and bills. They're increasing the price of those instruments and reducing the yields, which artificially lowered interest rates in the USA, increasing access to capital, artificially undermining the growth in asset values, and reducing debt servicing requirements. Underpinning, not undermining, underpinning the growth in asset values. Some people think there's not a correlation between cheap credit, cheap access to capital, and asset values. There is. China in particular adopted a policy of artificially pegging the exchange rate, significantly undervaluing it, which removed the brake on a surge in exports from China to the US. The upshot was that the cost of those imports would have been otherwise higher without the artificially pegged exchange rate, which would have increased inflation in the US because the cost of the imports would have been greater, so they'd been importing inflation. It would have increased interest rates and would have gone a long way to spiking excesses in the US asset bubble. Third contributing factor is the extraordinary expansion of the global financial market, its financial instruments, the mobility of financial capital, lack of real management of risk, and lack of transparency and governance. Globalisation has delivered unprecedented growth in an integration of global capital markets, transmitting capital and market sentiment almost instantaneously around the world and without check, dramatically increasing global financial assets as a proportion of world GDP. The financial industry has grown to represent around 25% of stock market capitalisation in the US and even higher in some other countries, including ours. When coupled with extraordinary financial engineering, which is the creation of sophisticated financial derivatives, a lack of transparency and accountability in their governance, a laissez-faire approach to accounting for risk, this conduct of financial markets has precipitated a boom and bust economic contagion across the globe. My understanding of this all comes down to a few key points. This was the Sunday night bit. There's been no strong requirement of transparency and accountability in financial markets akin to corporate governance. There's been a change in the way in which banks and other financial institutions account for loans and related contractual obligations, and therefore assets and liabilities on their books. I'll come to this in a minute. And this growth in financial engineering, which involves the creation of increasingly sophisticated financial instruments in the forms of securities or derivatives, the product of which I justifiably describe as casino chicanery, in leveraging credit and managing risk in order to increase profit. Chicanery is trickery or artifice. Let me explain. Back when I was a boy, loans used to be brought to book on the balance sheet of the originating or lending institution, which was exposed to the credit risk, to the market risk through interest rate charges, I should say, and to liquidity risk. That's the long maturity loans funded through shorter maturity deposits. And it was there for all to see. With the advent of financial engineering, including securitization of markets in the US, banks could sell their mortgage loans into government-sponsored security vehicles such as Fannie Mae and Freddie Mac and other institutions, and or third parties wholly or partly owned by the originating institution. In 1990, for example, 10% of US mortgages were securitized, 70% in 2007. What is really significant is that this form of financial derivative meant that these assets and liabilities were off the balance sheet of the originating institution or the bank. The ordered assets were not showing where the bank bore the ultimate risk for those assets and liabilities held by third parties. No transparency and accountability until the ultimate liability was realised with recourse to the originating institution. Nobody knew where it was and who bore the risk. As one well-placed to comment, George Soros, infamous hedge fund manager, famous, characterised this financial engineering, and I quote, a concocted alphabet soup of synthetic financial instruments, CDOs, CDO squares, CDSs, ABXs, CBMXs, etc. CDO stands for collateralised debt obligation. This engineering reached such heights of complexity that the regulators could no longer calculate the risks and came to rely on the risk management models of the financial institutions themselves. And sadly, much the same could be said of the CEOs of the 30 major global financial institutions which have failed or have been bailed out in 2008 so far. Quite simply, there is a profound lack of understanding of the non-reconciling of these financial instruments with the normal or traditional corporate lending behaviour and risk exposure that everybody in this room grew up with. It is little more than taking a bet in a casino. In this instance, the bet is for or against the prospects of a boom or bust. It's a bet against those institutions going belly up. In the words of Soros, quote, the esoteric financial instruments and techniques for risk management were based on the false premise that in the behaviour of the market, deviations from the mean occur in a random fashion. That's the platform for the bet. But the increased use of financial engineering set in motion an inevitable process of boom and bust. All of this is consistent with the ever-increasing use of credit and leverage and the inconsequence of risk, and all on the false premise that the behaviour of the financial markets influence the economic fundamentals. This is Peter said in his opening speech, quoting Hoover. And not the other way around. Markets do usually correct their own mistakes. My fourth contributing factor to this perfect economic storm is that the capital markets assessment of company values. Because interest rates were artificially depressed, and because markets had essentially stopped charging for risk, the discount factor on expected future earnings in determining net present values was similarly artificial. While many in our industry considered for some time, and I'm one of them, that the stock markets were undervaluing the industry and it was due for a re-rating before this crisis, it has arguably again overshot on the downside, inflicting on the industry a double whammy: an underrating on the upside and an overrating on the downside. Let's turn to the effects. The upshot of all of this is that the world is caught in a vicious vortex of, one, a crisis of confidence in capital markets, increasing credit defaults and prospectively in credit card, auto sales and business debt, yet to come, and capital liquidity constraints, all of which is decreasing the pool of available capital and curtailing investment. Secondly, a matching crisis of confidence among the consumers and businesses of the globe who are cutting back their discretionary spending in response. Thirdly, a structural recession in the US and a cyclical downturn in other major developed and emerging economies, although some of them have moved into recession, producing the only synchronised global downturn across the major economies since World War II. Emerging economies' growth is unlikely to offset the recession and growth decline in developed economies. Global growth is projected to be around 1.7% in 2009. Compare that to the 1991 recession, when global GDP growth fell to 1.5%. Next point, we got increasing unemployment, and starkly so in the retail and financial sectors, and there is reduced commodity demand, moderating supply, and a sharp drop in commodity prices. This is some of our own research, and it shows you the year-on-year drop in prices. Well, the year-on-year is the orange, and then October, September to September 08 is in the green. This vortex was exacerbated by the clumsy, inconsistent, and poorly planned early attempts by the US administration at government intervention for salvation. The prospect of shoring up confidence and not further eroding it is dependent on, one, how quickly and comprehensively the government, any government, the domestic government, puts its balance sheet on the line. Secondly, providing taxpayers with real equity in the risk-reward equation. In other words, if they're going to pay for it, they've got to have a chance of getting something out of it, than simply just being a sop to those who caused the problem in the first place. Thirdly, providing sufficient capital to banks and other institutions to properly write down the value of toxic assets to something realistic without destroying value and capacity to lend. And fourthly, guaranteeing interbank loans and customer deposits. For the Australian economy, there is a strong consensus that Australia has a much better chance of escaping recession than other countries. Treasury forecasts 2%, Reserve Bank forecasts 1.5% because they can't factor in interest rate reductions, and Access Economics is in that range in terms of real GDP growth, which is the gains in the real economy, and as this chart shows, the impact on national income, which is the blue, which is nominal GDP. In my view, this consensus appears based on 5 key factors that I can identify. First, according to Chris Richardson of Access Economics, who I have a lot of time for, even though there is a declining in mining and metals investment ahead, you can see that, there is momentum in business investment and economic infrastructure, transport, energy, water, ports and communications. This is not something you turn off halfway through, which will generate lag effects beyond the immediate impact of the financial crisis. That is, the investment and the effects are more drawn out and relatively inelastic to the current circumstances, far more so than the impact on discretionary consumer and discretionary business expenditure. Second factor, and why I think Australia's going to go okay, relatively, is the commodity boom has contributed, again, this is Chris Richardson's data, between 10 to 14% increase in national income, but that's additional over and above income levels had prices stayed at where they were in 2002-03 over the last few years, most of which went to profits and to jobs more so than wages. And significantly, the distribution was more across the economy than it was to the mining sector specifically. Only a third went to mining companies in terms of those profits. This is a key point. This so-called boom, current expansion, is starkly different from the terms of trade boom in the 70s. 2 decades of economic reform since have delivered an Australian economy that's open. Not only a greater resilience to external shocks, but a capacity for the economy-wide benefits, or the economic benefits of the boom to actually wash its way through the economy, which means that you don't have that aggregated pent-up heat in particular sections of the economy, which is far more likely to cause you problems. So it reduces the risk of underheating of the economy on the way down, just as it reduces the risk of the economy overheating on the way up. Hence, the impact of this current global turmoil will likely be mediated between a substantial hit to profits across all sectors of the economy and a slower wage growth and jobs. Again, as I said, providing a buffer to the negative impacts to specific sectors and on the way down. Third factor, the federal government's response to date is more in line with those fundamental points I gave you early on. And most commentators consider it quite appropriate. A fiscal stimulus and prospectively further stimulus in building critical infrastructure and a preparedness for the budget to move into deficit. I think this debate we're currently having now about whether you use the D word or not is just over the top. There's absolutely nothing wrong with having the budget in deficit through the economic cycle in the same way as we commit to having the budget in surplus over the economic cycle. Second point is that bank and other institutions deposit guarantee. Third point, global engagement and coordination of measures. This is a global problem, needs a global solution for a globally integrated financial market and industry. Further, promotion of trade liberalisation, and certainly no backsliding to protectionism. Stronger regulation of financial institutions, and specifically the prudential lending rules governing capital adequacy ratios, and the establishment and use of financial derivatives. As Soros comments, limits on credit and leverage will have to be set substantially lower than those that were tolerated in the recent past. And lastly, though not directly within the purvey of government, of course, Australia is well served by an easing in monetary policy and more expected into 2009. My fourth point as to why I think Australia is well placed is the extent to which we have diversified our exports. As you can see from this slide, we are less dependent on OECD markets than we used to be. We have significantly increased the diversity of our exports to Asia. Japan remains a very important market. It still accounts for over 40% of Australia's total coal exports and just under 40% of iron ore and aluminium exports, for example. But China has quickly become our major iron ore export market, and increasing its share of all Australian minerals from 5 to 20% in the decade to 2007. India has increased from 1% to 10% in the decade to 2007. Japan has remained relatively constant. Korea's share has fallen from 19 to 8% over the same period. My final factor in determining Australia's consensus forecasts, in other words, that we're in a position, is that the fundamentals underpinning the super cycle of demand remain largely uncontested. And if Australia is able to capitalise on the downturn by addressing the supply capacity constraints to growth, then we should be well positioned to further capitalise on demand when demand kicks back up to or exceeds supply. Let me canvass this last point, and I'll do so by revisiting and briefly testing each of the fundamental structural adjustments that we have previously identified many times that have given rise to the most significant transformation in the fortunes of our industry in a generation. My thesis, quite simply, is that the underlying fundamentals for growth over the economic super cycle have not markedly changed. And indeed, the current economic turmoil may well add to the longevity of that cycle in the medium to longer term. The new global order. Year zero over there is when Jesus was born. Quite literally. This is the modern era. The rebalancing of global economic development and strategic power from developed economies to emerging economies. The world is going back to look more what it used to be in the first 1800 years of the so-called Common Era. That's China on the bottom. It's no short-term phenomena. and is unlikely to be derailed by the current financial turmoil. The rapid industrialisation and urbanisation of developing economies will continue. Half the world is going through an industrial revolution comparable to that in the US of the 1890s and Japan in the immediate post-war period. China is projected by the World Bank to be the largest trading nation by 2020. Remember, I said it's not export-dependent economy. And the largest economy by 2030. By 2030, in our lifetimes. Though this slide suggests that might be achieved even earlier. Wrong slide, sorry. That one. This slide suggests it might even be achieved earlier, by 2025. In 2030, the World Bank also projects that India's economy will be larger than the US economy in purchasing parity terms. The major developed economies of Brazil, China, Brazil, China, India and Russia and Indonesia are expected to continue to experience strong growth in real GDP for some time. As such, the centres of global growth will increasingly shift to the emerging economies. During this decade to date, the US has contributed around 1/10 of global growth. China has accounted for more than 1/3 of global growth, and Western Europe about 1/12. Developing economies, emerging economies, developing economies now account for more than half of the global economy, and since early 2007, a remarkable 3/4 of global growth. As I indicated, these emerging economies are increasingly less reliant on export growth than domestic demand, growth in the form of consumption and investment, and they are more reliant on intra-Asian trade than they are in trade with OECD countries. As I said earlier on, witness the emergence of the Asia factory, components coming from Asian countries being put together and assembled in China and India and then exported to the rest of the world. The real question is the extent to which emerging economies, and I think that's where that slide should have been, but you saw it. The real question is the extent to which these emerging economies' growth will offset the decline in developed economies' growth, the rate and extent of recovery, and the extent to which that will be a drag on materials demand. Per capita metals and energy intensities, as you all know, increase as countries develop and income per capita increases. But they are a mere blip in emerging economies, as you can see down the bottom there. The thing's gone off the table, but this is per capita income across the bottom, and that's base metal consumption per capita on the other side. This is what happens when you use a Mac computer. You lose stuff. We're transitioning. So there's significant upside demand growth even when modified for currency corrections, product substitution, or other moderating factors. And although developing economies account for in excess of 50% of the world's metals consumption, their per capita use is only a fraction of developed economies. The per capita metals intensity of developed economies is 5 times that of emerging economies. Energy demand, same story. Use is strongly correlated with economic growth, particularly growth in industrial production and associated developments such as urbanisation and manufacturing and rising incomes and quality of life. So, you've all seen this. This is some work we commissioned way back. We started looking at what was happening in 2003, 2004. This is the trade boomerang. You can see income per capita on the left-hand side. The bottom side is basically demand for raw materials, the x-axis. And you can see there that where India is today is where the USA was in the 1890s. Where Japan is today, where China is today is where Japan was in the immediate post-war period. There's 1 billion people on the top end of that curve. There's 3 billion people on the bottom end. And as they move through, that point of inflection is about $7,000 to $10,000 per capita. That's where they get to the point, and then they start increasing. The rate of increase of metals and energy demand increases at a decreasing rate. Hence, it comes back on itself. But the point is, these countries are going to go through that cycle, same as everybody else, which means they'll have demand for our materials. So all this means that our trade boomerang is still good, as an indicator of the potential for Australia to supply countries moving through the phase of economic development and an exponential growth in their demand for our products. In this context, you can't talk about raw materials demand without looking at the BRICS countries, Brazil, Russia, India and China. And from our perspective, the latter two in particular, India and China, and the continuing demand from traditional markets, particularly Japan, Korea and Taiwan. Let me just make a couple of brief points about China and India, because they're so special in this whole equation. China has enormous financial resources. They got $2 trillion US in sovereign wealth funds. Low inflation, one of the strongest in the world, school-educated and low high-skilled demographic profiles, likely to sustain industry competitiveness until 2050, and they have the social and political imperative to grow. The investment to GDP ratio is high, but it's mostly equity, not debt. More wealth generation than consumption, and therefore less exposed to the risks of a flight of capital, which precipitated the Asian financial crisis in the mid-1990s. As I indicated many times through this address, China and India have transitioned from a production-driven export economy to an economy far more driven by capital spending and domestic consumption. The principal growth drivers being urbanisation, housing, rising incomes, high-value manufacturing, rural development and structural reform. And China has just announced, this gives you an idea of urbanisation. They're building a New York City every 6 months. They're putting a gigawatt of power in every 9 days. We've got 45 gigawatts in Australia. Gives you a rough idea. They're going to have something like 20-odd cities that will be way over the 20 million mark. They've got something like 40 to 50,000 skyscrapers on the deck. This is not something, this machinery is not going to turn off overnight. China's announced a further fiscal stimulus package, $855 billion. Some of that's got some double counting in it, as you've heard in the press, but it's still a massive stimulus. And it's one aimed squarely at the resource-intensive users, such as building infrastructure, highways, railways, and airports. That package is expected to translate into a fiscal stimulus of about 1.5% to 1.7% of GDP. Remember I talked about 2% GDP in terms of loss of exports to the USA? Which will support growth in the order of 7.6%. Could go as low as 7.2%, but it's still ahead of what most commentators think is the technical level, 7 to 8%, of when China actually can move into severe contraction with all of the associated issues of political stability, social and political stability. Australia's mid-year economic and fiscal outlook revised the growth forecast for China down to 9.75% in 2008 and 8.5% in 2009. India's following much the same path as China. What this tells you is that India's household income distribution is expected to change markedly. This chart demonstrates that the percentage of India's middle class, i.e. those between 4,000 and 18,000 per annum, will increase from 20% in 1995-96 to 38% in 2006-07. That's 80 million households, equivalent to 480 million people, will have that kind of purchasing power. The second of my underlying fundamental adjustments is rationalisation, consolidation and increasing global integration of the industry. It will continue. It may even accelerate. Mining has evolved from its nationalised local roots into a truly globally integrated industry as companies pursue economies of scale, product diversity, greater inventory and supply control, better costs and pricing discipline, stable cash flow through the commodity cycle, greater options in risk management, and better strategic employment and deployment of capital. You can see from this slide that there's been a massive acceleration in the rate of mergers and acquisitions through this part of this decade, to the point where if you pick most of the main commodity lines, the top 5 are doing somewhere between 40 and 80% of supply and probably a greater proportion of inventory. At the start of this century, there was still a strong spread of local, regional and or integrated single commodity companies across key geographies. This is courtesy of Mick Davis from Xstrata, that one, as is this one. By 2008, there's been a profound shift to heavily diversified global companies built on a combination of mergers and acquisitions and organic growth, concentrating their efforts on high productivity Tier 1 projects, current operations and in the growth pipeline. It's unlikely that this trend will be affected by the current financial turmoil, other than perhaps accelerated, as some companies face financial equity constraints in accessing capital to grow the business and or sustain it in periods of negative cash flow. This may be more pronounced among the small to mid caps, those operating with Tier 2 and 3 projects and or operating in the higher end of the long run average cost curve. The third key structural adjustment is the manner of the industry's operation and its practical commitment to sustainable development. For those of you catching up with where I'm at, I'm actually going through each of the fundamentals that we have talked about and I'm checking them off against the current turmoil. Our commitment to sustainable development has been foundation to a remarkable transformation over the past decade in the industry's stewardship of the environment, its people and its operating communities. It's been fundamental to recovering the industry's social licence to operate and is critical to maintaining it. This is the unwritten social contract with the communities in which you operate, far more enduring than the regulatory licence and really critical. It's our interpretation of corporate social responsibility. I'm really quite staggered that some, albeit external stakeholders, would countenance that there could be any substantial or any substantive consideration in the industry in backsliding on its commitment to sustainable development. The shift in the industry's method of operation, this commitment to sustainable development, the practical implementation, can only ever be founded in the business case for sustainable development. There is an inherent contradiction in justifying the practice of sustainable development in altruism or welfare. It's just simply not sustainable in a commercial sense. That said, the business case will undoubtedly become even more acute during this tumultuous economic period, but it will still be the business case that justifies the industry's commitment to sustainable development in its operations. The fourth structural adjustment the industry faces are the supply capacity constraints to growth. As this slide indicates, as our sector moved through the 90s, the difficult period where the industry was barely recovering the cost of its investment capital, the accent was on the efficient utilisation of capacity. Today, we hit full capacity, and the focus has transcended to building absolute capacity as supply has struggled to meet demand. Increased global demand for minerals products prior to this crisis sponsored higher prices more so than sponsoring additional supply. Indeed, supply has virtually limped onto the market, hampered by a period of underinvestment during the late 90s, early 2000s, and the current capacity constraints, many of which are a global phenomenon. And it has cost us real market share and export revenue over the period of the current expansion. Research we commissioned under our 2020 Vision project by Access Economics showed that if Australia had maintained global market share between 2002 and 2007, we would have earned another $17 billion in 2007 prices. That's equivalent to 1.6% of nominal national income in 2007. There's no shortage of global natural resources, as if I need to tell this audience that. For the foreseeable future, the global resource base is not likely to be a major constraint to supply. So if we've got a supply problem, we need to look in the mirror. Capacity constraints are and will continue to be the economic policy issues of the moment. There's a great list of them there. You can work them through. They include congested and poorly functioning export corridors, failing social and physical infrastructure, particularly in remote and regional communities, human resources skill shortages, excessive and inefficient regulatory requirements for occupational health and safety, and land access and use, and limitations on critical production inputs, added to which, as Peter said, the industry is striving to reconcile energy security with managing climate change, contribute to building sustainable Indigenous communities, and to increase professional capacity to implement sustainable development. These constraints are unlikely to be transient in their nature. They are increasingly a factor in determining a country's competitiveness and attractiveness to investment in a highly globally integrated industry. That in turn is very much a factor of how quickly countries remedy supply capacity constraints, and this is foundation to the MCA's 2020 Vision Project, and this was about where I was going to start my address 6 months ago. That was funny, guys. To recap what I said earlier, the MCA's 2020 Vision Project is designed to forecast the scale of the opportunities, assess the capacity building needed to meet those opportunities, and to identify the policy actions and settings necessary needed to build that capacity. Boom, boom. Supply is the great unmentioned in the current debate about our industry's prospects. Demand has figured prominently, and it's only latterly that people have started to dawn on the other side of the equation of what's going to happen to supply. New supply takes a long time to develop, but not all that long to shut down, as we're currently witnessing, as companies move to reduce production to better approximate the current and anticipated slowdown in demand, added to which is the probability that some operations will either shut, scale down existing operations, and companies defer or shelve investment in new production. The bottom line is that on the basis of what I've just gone through in terms of the strength of the underlying fundamentals, it is not unreasonable to conclude that demand will kick back to or exceed supply. And what does that mean? Well, commodity prices are very sensitive to international stock levels. If stock levels increase only marginally, prices can come down more quickly than the reduction in stocks might suggest. But if stock levels are low, price increases can be quite dramatic, as we've witnessed over the past half-decade. The point being that when demand kicks back into or above supply, prices are likely to move rapidly, and we need to be sure that we here in Australia do not again bemoan our lack of action ahead of an anticipated opportunity and get left in a supply vacuum. This is the foundation to our very strong focus on and drive in remedying capacity constraints and growth, among other critical determinants of the economic environment conducive to investment and growth. The increase we need in minerals production by 2020 if we are to maintain current market share. Massive, huh? Nickel up by 120%, iron ore by more than 100%, zinc and copper by more than 80%. This is on today's productions. Coal and lead by more than 40%, aluminium by more than 20%, and gold by around 15%. The benefits of getting that right are absolutely amazing. Okay, if we just hold the line, we could be $129 billion better off, 8.5% of today's national income by 2020. The cost of getting it wrong, the decline scenario, we lose $91 billion, which is about 8% of today's national income. The benefits of getting it even better right, in other words, the advanced scenario, maintaining a growth rate of about 3.1% gain in market share per annum, which was essentially what we expect to do between 2007 and 2013 on account of investment. Remember I talked about the lag phase of the investments we've got going? Under that, we should be about another $129 billion better off, which is an increase of 12% of today's national income. You're not going to remember those figures. All you have to remember is it's big, and it's massive, and it's good for us. So, Mr. Chairman, in conclusion, you've just heard, to my knowledge anyway, a world first. I don't know anybody in the minerals industry around the globe is, certainly in my business, probably in companies they have sat down and gone through, one, what the current turmoil looks like, two, what we think that's going to do to the economic fundamentals, and three, what does it mean for our policy and advocacy work. And it was a good weekend's work, and I'm delighted I've done it. So my take-home messages to you are that the current turmoil in the global economy, its product and capital markets, was an economic storm waiting to happen, and few really know how long it is going to rage. We do know that within this storm, while there will be some damage, even wreckage, the fundamentals will remain relatively unscathed. And if the Australian economy, and specifically the Australian minerals industry, is to fully capitalise on what we expect will be a recorrection in the market, then this is an opportunity for government and industry in partnership to have a serious crack at remedying the supply capacity constraints which will otherwise restrict our growth and this nation's national income in the future. Thank you.